everyone. My name is Ben Sutton. I'm an accountant and founder here at Mazuma. Thanks for joining us today for our year-end tips for small business webinar. Just want to remind you that these webinars are recorded and posted to our YouTube channel. So if you like this content, then go there and check out the video and subscribe. It really helps us out a lot to know what kind of content and topics you like us to cover, as well as deliver the content to more people. If you need more information once the webinar is over, you can always head to our website at mazumausa.com. And Mazuma clients can also log into their dashboards and get in contact with their assigned tax professional if they have additional questions by chatting in. Following the webinar, we'll have a short Q&A session. So if you have any questions that are related to our topic today, click the Q&A box at the bottom of your window and type your question in there. I'll be happy to answer them when the time comes. Alrighty, let's go into our topic here. So the big picture of what I hope to help you with today is first an understanding of, just a basic understanding of how taxes are calculated with the tax bracket system that the U.S. has. We've got a graduated tax bracket, right, that plays into how your taxes are calculated and also therefore plays into tax planning. So I'm going to talk about those for a bit, and then I'm going to move into some of the things we can do to get our taxes down before the end of this, certain things that need to be done maybe before the end of the year to get our taxes down. And then I'm going to hop over to how deductions work, right? How income and deductions work in pass-through entities like LLCs, S-corps, and the businesses that most of us own as small business owners. So we're going to try and package this all up into 20 minutes, much more than that, and our eyes will be glossed over. But again, if I don't address something that you're really interested in learning today, then please type it into the Q&A panel. All right, so in the U.S., we've got a graduated tax bracket system, and this is the process of or the way the government determines what rate of tax to charge us, right? We all know if we make a smaller amount of money, then our tax rates are lower. If we make a lot of money, if we're a high wealth individual, then we're paying a higher tax rate. And whether you think those are high enough or whatever, that's a different discussion, but this is how it works. And so we've got these brackets that our taxable income is calculated against to come up with how much tax we owe. What I want to emphasize here is that, and I'm going to show you these brackets in just a minute, but these tax brackets apply to your taxable income. So we've got gross income, like your W-2 and all your net business income after business expenses that passes through to you. You've got maybe retirement distributions coming out. All of that makes up your gross income on the personal tax return. And then we get to take some extra deductions like mortgage interest, charitable contributions, if we're itemizing our deductions, that is, and maybe some higher education deductions. Those things serve to reduce our gross income, reduce our AGI, or down to our AGI and our taxable income. Okay, so once we take away all those deductions, then we get to our taxable income, and that's when these tax brackets come into play. All right, so let's real quick take a look at these tax brackets, see if we can pull those up on the screen if possible. All right, so as you can see here, we've got the rates off to the left, starting with 10% is the lowest and 37% is the highest. Then we've got three columns that pertain to your filing status. So the first column is for single filers, the middle column is for married filing joint filers, and up to the far right is for heads of household filers, which are a smaller group of filers, but single people essentially who are taking care of dependents. I'm going to focus in here on the I guess I'll stick with the married filing joint column, but you can follow the logic no matter what column you're at. So with this system, if you have taxable income, again that's after standard deduction or itemized deductions, of $19,750 or less, then all of your income is going to be taxed at 10%. So if my taxable income is $10,000, my tax liability is going to be $1,000. All right? But if we go up, and let's say we have taxable income of $50,000, which is right there in the middle of that 12% tax bracket, right? That starts at $19,750 and goes up to $80,250. So that means the first portion of my income from zero taxable income to $19,750 is taxed at the 10% rate. And then the next portion of my income, starting at $19,751 up to $50,000 in my example, that next portion is taxed at 12%. All right, so I've got a portion that's taxed at 10, and then a portion that's taxed at 12. If I've earned $100,000 of taxable income, then I'm up in the 22% tax bracket. I've got a portion, I've got $19,750 taxed at 10, I've got between $19,750 and $80 taxed at 12, and then from $80,250 up to $100, in my example, is taxed at 22%. So that's 10% more than everything that I earned below $80,000. So that's a big jump right there, right? And that kind of shows you where Congress kind of decided they're gonna get us, I guess you'd say, because they almost doubled the tax on everything we make over $80,000. All right. So in our tax plan, I'm going to stop there, but you can see how this works, right? So the more you earn, the higher the tax rate goes. It doesn't mean everything you earn is taxed at the higher rate, but that upper layer is taxed at that highest rate. All right. So, and again, all the way up to 37%, we can see that happening. So I'm going to stick with this example real quick of earning $100,000. So from 80,000, I'm just going to round that out, 80,000 to 100, I'm paying 22% tax. If I can get down, so that means I'm going to save 22% tax on everything that I can get down from there, down to 80,000. Now, if I keep getting my taxable income down below 80,000, I'm only saving 12%, which is still good, but man, saving 22% from that 100,000 down to 80 gets me a lot more bang for my buck, right? So knowing about these tax brackets and knowing about where you fall in the tax brackets can help you determine how much urgency you should have about saving taxes, about driving your taxable income down. Because let's say that I earned $80,000 total. Well, okay, anything that I drive down is going to save me 12%. But if I earn $85,000 and I know that that last $5,000 is 22% taxed, I might do a little bit more, have a little bit more urgency about getting rid of that top $5,000 of taxable income. All right, so I hope that sinks in a little bit. And let's go ahead and move on now. I mentioned, let's bring up the standard deductions real quick. So I mentioned we have our gross income. So just for now, let's think about this as our W-2 income. And from that, we go down to taxable income by either taking the standard deduction or our itemized deductions. Okay, so the standard deduction is what the government gives us right off the bat. And it's just a base amount. They give everyone this standard deduction. If you're married filing joint, you get $24,800 of deduction. So if I have a $100,000 W-2 income, I'm not going to be taxed on that $100,000. I'm going to at least get to take this $24,800 standard deduction if I'm married filing joint and pay taxes, and then my taxable income is going to be dropped down to about $75,000, right? So now if I itemize my deductions, if my itemized deductions are higher than $24,800, then I'd prefer to take that instead of the standard, right? And those itemized deductions are mortgage interest, charitable contributions, and state taxes. And then if you've got big medical expenses, those count also. So if all my mortgage interest, charitable contributions, state taxes, which are capped at $10,000, plus my, if I've got excess medical expenses add up to more than $24,800, then I'm going to itemize instead and get to take that higher deduction and drive my taxable income down even further. You don't get to take both. You don't get the standard plus your itemized deductions. It's just the standard or your itemized deductions, basically whichever one's bigger. Okay? Now I want to say one more word about going from this gross income number to taxable income. And we can probably pull this slide down now. So if you're a business owner, you've got the gross income of your business, meaning everything that your customers paid you, minus your deductions like travel, supplies, insurance, office expenses, all that, everything that's a business deduction. You take what the customers paid you, let's say that's $10,000, minus your expenses, deductions, let's say that's $5,000, you're left with a net profit of $5,000. That $5,000 profit is carried over to your personal tax return as gross income. Okay, and it's added up with your W-2 income and any other income sources you have. So the net profit of the business becomes your gross personal income on your personal tax return. And then you take the standard deduction away, you take your gross income minus the standard deduction. I'm simplifying here, but to get down to your taxable income, there's a lot more things that go into, that can reduce your gross income down to your taxable income, but that's the general idea. Down to your taxable income, and then that runs through those tax tables to calculate your taxes. All right? Then after you've calculated your taxes, you look at tax credits, like for your kids. That's the common one, right, that we know about, is you get $2,000 off of your tax bill for each qualifying child under 17 years old. So I hope that the basics of that process kind of settle in for you a little bit, and that you recognize a little bit more about these tax brackets and how they factor into your tax planning and some of the urgency behind whether you should take action at year end or just kind of not worry about it and pay the taxes. All right, because if we're just popping over that into that 22% tax bracket, for example, we want to get that down so that none of our income is taxed at that higher rate. Obviously, if we're at the higher tax brackets, we want to get it down still, because 22, 24%, that's a lot of taxes. But that does factor into some of these decisions you might make at year end. So let's talk about things you can do at year end. All right, you've probably, we all know about the buying the car at the end of the year strategy, and that's a valid strategy, but it falls under the idea of investing in equipment for the business. The government, with the tax law change at the end of 2017 and 2018, made it very nice in that they allow us to depreciate 100% of large capital expenses. It used to be cars and other large equipment. You'd often have to depreciate those over 5-7 years or longer before you got the full deduction. Well, now they're saying you can take it all up front. And that's whether you finance these large equipment purchases or pay cash for it. It doesn't matter. If you've executed the transaction before year end, then you get to take 100% deduction for the business use portion of whatever asset you purchased. So, a dentist might be looking at a new x-ray machine. That's definitely going to be 100% business use. If it's a $100,000 machine, he gets $100,000 right there at the end of 2020. That's $100,000 off of his income. If a photographer wants to buy a new camera, right? She goes out and looks at the nice cameras, $5,000 camera. She could put that on the credit card and still get a full $5,000 deduction at the end of the year. All right, and that's because of this bonus depreciation rule that's in play right now. And so the thing to consider with these equipment investments or vehicle purchases at the end of the year, you don't want to do it just to do it. Don't spend money just to save taxes. All right, spend money if it's going to benefit you and save you taxes. Right, so make sure you're getting a real benefit, real value out of whatever you're purchasing, like that car, or that camera, or that equipment. But don't just go spend money just because you're going to have to pay taxes. It's kind of flushing money down the toilet just to pay less to the government, which, hey, we all like paying less to the government, but we also like keeping some in our pocket too. So be wise about those year-end purchases. But if you're looking into next year and you're saying, well, I'm going to need a camera, I'm going to need that x-ray machine probably by March, April, May of next year anyways, might as well go ahead and make the purchase before year end, finance it if I have to, and save that tax money. All right, so that's one year-end strategy that can be done to drop yourself down into that lower tax bracket. Next one is, along those same lines is where I talked about looking into the next year and kind of seeing what your needs are going to be and then taking action. You can prepay expenses before the end of this year and deduct them in this year as long as you make the payment before the end of the year. All right, so if I'm looking out ahead and I see, I've got this software license. This is probably a really good example that I'm on a monthly subscription for my editing software, and it costs me, let's say it costs me $200 a month because I'm on a monthly subscription. Well, they also have an annual plan that if I pay $1,500 once a year, I'll save money and won't have to do it monthly. Well, if I can do that before the end of this year, prepay for that software license and take the full annual deduction in 2020 instead of 2021, get the tax deduction now instead of having to wait till the end of next year to realize that tax deduction. All right. So other thing, you can prepay utilities. I've seen people prepay rent. You can prepay a lot of things that maybe you haven't thought of. That if you're confident, you wouldn't want to prepay rent if there's any possibility you're going to be moving out. And I'm talking about business rent. But look ahead. Look at those things that you're confident you're going to be using and needing. And go ahead and make those payments before the end of the year as much as you can if you've got extra cash to do so. And that'll, again, another way to drop yourself down into that lower tax bracket potentially. Okay, the third way I'm going to talk about is retirement contributions. These are an option for anyone who is earning income in their business. Namely the SEP IRA and the 401k. These two retirement plans are the most commonly used ones in the small business world. The solo 401k is just like a regular 401k, but if you don't have employees. Okay, if you and your spouse, let's say, are the only employees of the business, you can open up a solo 401k and do it just for yourselves, which is great. And we've done a full-blown deep dive discussion on retirement plans, and we even include the simple plan earlier a few months ago. So I'd reference you back to that for details. But in summary, the 401k will allow you to contribute $18,000 as an employee plus 25% of your payroll from the employer. The employer side of the company side can contribute up to 25% of your W-2 wage. So you can defer $18,000 out of the your employee paycheck, your own paycheck, and then add to that $18,000 up to 25% of your wage. Now this is money that is being paid in to a brokerage account of some kind, your mutual funds, your 401k account. And if you pay it in, the government will give you a deduction for that right now. Basically, they say you don't have to, we know you're just saving the money and you're not spending it on business expenses, but if you put it into a qualified fund, like for a 401k, then we'll give you a deduction. And of course, they know down the road, when you pull that money out, they're going to tax you on it then, but that's the give and take, right? So the thing to remember about 401ks is that you need to form the 401k plan before the end of the year. Okay, you don't have to pay the money in. You don't have to give the money to the custodian or the brokerage account before the end of the year. You just have to make sure your plan is set up before the end of the year. And then you have to pay before you file your business or personal tax return. Okay? So that's a real nice benefit. You get to hold on to the money. You can even maybe see how much taxes you're going to owe before you decide how much you're going to contribute into that 401k. All right? And same concept with the SEP IRA. All right? It's the same idea, but with a couple differences. The SEP IRA does not allow you to defer the $18,000 of employee contributions. It only allows you to do the 25% of your W-2, or if you're not a W-2 employee and not an S-Corp, it's 25% of your profits you can contribute into that SEP IRA. Same idea with the solo 401k, but so the little difference there is there's no $18,000 employee deferral on the SEP. You can still do the employer contribution up to 25%. The limits are the same. The most you can get in there altogether is $56,000 this year. The nice thing about the SEP is you don't have to form that before the end of the year. It just has to be formed before you file your tax returns. Same rule, you don't have to pay before the end of the year either. You just have to pay before you file your tax returns. So be aware of those two options. You'll probably find the SEP is cheaper. Usually there's no maintenance or filing requirements with the SEP. It's just you set it up and then it runs. I'm pretty sure they're free. There might be a small administrative fee, but the 401k does usually have like a monthly administrative fee that you'd want to look into. So again, that's another way of getting a significant chunk of money. Like we're talking about a situation where you've made money and need to get money into, out of your gross income to drop yourself down into a lower tax bracket. And retirement contributions are a good way of doing that if you don't mind the fact that you're going to pay taxes later on that same money. Okay, so let me reiterate real quick what this means. If I do, let's say I do throw a $10,000 into my SEP IRA. And by the way, before I move on to that, I meant to mention you can still have a traditional IRA, and with the $6,000 max contribution, whether you're a business owner or not. You've just got to have earned income to qualify for that. If you've got too much earned income and you've got a plan under your business, you may be prevented from contributing to a traditional IRA. But for the most part, you can do both. I just want you to know that you can do the traditional and the SEP or 401k if you wanted to for some reason. So let's say that I decide to put $10,000 into my retirement account or buy that piece of equipment for $10,000. It doesn't matter. I'm gonna do something to get my tax bill down by $10,000. So what does that translate into, right? If I'm in that 22% tax bracket, that $10,000 is going to result, that $10,000 of income, if I don't get any deductions, is going to result in $2,200 of extra taxes on my bill. If I get rid of that $10,000 of income by buying that piece of equipment or contributing to an IRA, I'm going to save $2,200 of taxes. Okay, I want to make sure that that's just clear and in our brains so that when we're running up to the end of the year and I'm saying, well, I'm going to spend $1,000 on this thing, how much is that going to save me? Well, whatever tax bracket you're in, just multiply the tax rate by how much you're going to spend, and that will tell you how much you're going to save. Okay, so that's the quick formula for knowing. So $1,000 purchase, if I'm in the 22% tax bracket, it's going to save me $220, right? So I just want to make sure that that's clear and easy for you to have a gauge, because when you're going up, when you're about to make these decisions and you're debating, it's important to know, well, is it worth it, right? And that might factor into your decision there. The last thing I'm going to cover before we get to your questions is what happens to the money that you make in the business, right? If you've got an LLC or an S corporation, any pass-through entity, which LLC, S corporation, or even sole proprietors are treated the same way. If you earn money in that business, you earn a profit, okay? That profit is passed through to you as the owner, or all of the owners, regardless of whether you leave the money in the business bank account or take it out. Okay, so if I generate a $10,000 profit for the whole year, and so I've got about $10,000 sitting in the bank right now that came from all my work making money, and after I paid for all my expenses, I've got $10,000 left. That $10,000 is going to flush right through to my personal tax return. And if I have a 50-50 partner, she's going to get $5,000 and I'm going to get $5,000. All right, and that flows through on the form K1 and gets reported on each owner's individual tax return. Okay, and that $10,000 is still sitting in the bank, and yet I'm getting a K1 saying that I made $5,000, or as a whole we made $10,000. So be aware that leaving the money in the business account does not reduce or affect your tax liability at all. Right? You're going to pay taxes on that profit no matter what. The nice thing is that you're only going to pay taxes on that profit one time. So let's say we leave that money in and it's sitting there, and next year we decide to take it out. Well, that's great. It's not taxed when we take it out because it was already taxed when we at the end of last year when we filed our taxes. So you are only taxed on it one time, and there's no way to avoid that happening. That the year that the profit is generated in is the year that you are taxed on it. Okay. All right, and then so let's talk about the inverse of that a little bit. What if you put money into the business, into one of these pass-through entities? You take it out of your savings and you're starting up this business, so you need to put 10 grand in. Does that give you an automatic deduction? Well, no, it doesn't. Contributing money into a business is not a deduction in and of itself. Now, if that business took that $10,000, spent it all, and didn't earn any money generating income yet because it's in the startup phase, then I've got a $10,000 loss. Now, then I'm getting a deduction. That $10,000, just like that $10,000 income flowed through to the owners, the $10,000 loss, because it was spent on business expenses, created the loss. That flows through to the owner's personal tax returns as well. Okay, so I would, in that scenario, get a loss, but the mere fact of putting money in does not give me that deduction. The business has to go spend that money before I get a deduction for it. All right, so I hope that paints a picture for you a little bit to see some of the mechanics of how the taxes work and some of the paradigm or the framework to use when going into year end and considering how to get your taxable income down, and hopefully that helps you with some tools that can guide your decisions here at year end.